Good afternoon, and thanks for joining. This panel is going to be talking about the evolution of long-term asset allocation. And maybe some of the views will be a little bit less sanguine than some of the things I've heard over the last couple of days. And we're in the middle of a very bullish market. The risk on trade is alive and well, and we're going to maybe try to get the allocator view. Not necessarily lost on me, and maybe the folks in the audience, and I'm not sure if Nick or anybody else from CAIA is here, but up on the SALT stage, probably literally above us, is the evolution of the private markets investing, the GP side. So maybe we could do a point counterpoint or a split screen on CAIA. I think it would be very interesting. Or we can maybe crash that party afterwards. But perhaps I'll have my panel introduce themselves first, and just, I think the bio's in the program, but maybe just to hit the high points and your plan. And Al, I'll start with you.
Thanks, Bill. So Al Kim, I'm with the Helmsley Charitable Trust, which is a private foundation based in New York. Helmsley's mission overall is to help improve lives in the US and globally by supporting and funding various healthcare research initiatives. So type 1 diabetes and Crohn's disease being two of our bigger programs. On the investment side, we manage a $8.5 billion endowment. We invest across asset classes. We are very opportunistic, and we implement using a concentrated approach in our manager relationships.
Thanks, Al. Geeta?
I'm Geeta Kapadia, and I head up the investment team at Yale New Haven Health System. We are the academic medical center associated with Yale University, based in New Haven, Connecticut. My team and I manage about $5.6 billion worth of investable assets, covering defined benefit, defined contribution, and endowment-like assets. We manage across the spectrum from very plain vanilla fixed income all the way to private equity, venture capital, and real estate.
Thanks.
I'm Angelique Sellers, Managing Director of Investments at Penn State University. I don't think I need to tell you what Penn State does, but we manage a pool of assets of about $6.1 billion, and it, much like my fellow panelists, allocated from anything from fixed income to private equity, venture, natural resources, commodities. You name it, we probably have it.
Thanks, Angelique. So since you have the mic, maybe I'll start with you and work our way around. So I saw recently Abu Dhabi Investment Authority, who by all accounts is a very sophisticated allocator, sovereign wealth fund, and they just put their annual report out. And for a pretty secretive organization, there was a lot of public information in there. And the name of the report is called Prudent Global Growth. And their 30-year return annualized is 7.2%. Probably a little bit below what many public funds are shooting for as a bogey. So I want to start the conversation by saying that being an allocator is not an easy job. And this space has gotten very, very complex. The endowment model is now over 50 years old. So maybe starting with private equity, which has gotten a lot of play at this conference in the marketplace, is that an asset class in your view, or more of a very complex industry?
In our view, it is more of a complex industry, and we've been very sort of bottom-up about it. We don't have any particular buckets to fill generally in our portfolio. So when we look for managers, we can create a bucket rather than have a bucket and put the manager in there. And so on the private equity side, it is a very difficult job right now, given where things stand in terms of valuations, which has already been discussed at this conference. But we're still finding opportunities. We're looking more kind of a sector focus, a little bit more kind of differentiation. We're looking at smaller deal sizes, and managers kind of focused on that right now.
So Geeta, maybe the same theme, and I'm going to leave Adia after this, but they describe private equity as intense and accelerating in terms of the competition. So what do you think about the current vintage year and accessing perhaps different vintage years, either through secondaries, or do you think about co-investing or direct investing? And maybe your plan is of such a size that some of those are not viable.
Yeah, I think there's a lot of opportunity for investors such as us, but it's often quite difficult to differentiate between true opportunity and what may be a temporary area of interest for us. So we're very fortunate in that we tend to be, similar to Al and Angelique, we tend to be very long-term investors. So when we consider opportunities in the private space, we're really able to think of them over a 10 to 20-year time frame. And we've been very fortunate in that we don't really look at cyclical parts of whether or not parts of the market are attractive or less attractive or overvalued or undervalued. We're really just trying to make consistent commitments over time. And it may play, we may be able to participate through a co-invest or a secondaries opportunity, but really similar to the way Angelique described it, we're really looking at very bottom-up fundamental opportunities that seem to partner well with what we're trying to achieve over the long term. And so they can manifest themselves through a variety of different structures or deals.
And the importance on manager selection in the process?
Yeah, we feel very strongly about very fundamental manager due diligence, particularly on the private side. Again, we feel like there's a lot of uncertainty, and so to be able to really understand the managers with which we're partnering is probably the highest priority. It's been difficult during COVID, obviously more difficult than it was in the past, but in some ways it's presented us with new opportunities to meet fellow allocators, to do reference checks with other investment managers, talk to leaders in the industry, and really just feel like we have even more pieces to the puzzle to be able to make a good investment decision.
Al, maybe just closing out the discussion of private equity, maybe the view from Helmsley in terms of how you think about this market in terms of sector, geography, the SME space versus the buyout space. How do you think about allocating to private equity?
Yeah, so I guess compared to other foundations based in New York that have been around for decades, the Helmsley Trust is actually fairly new. The team really got started in 2010 upon the 2007 passing of Leona Helmsley. And so the Helmsley team was in a place where it is essentially started the investment office from scratch. It convinced our investment committee and trustees to build out a private capital program from nothing. And so 10 years later, it definitely has been a journey. In the beginning, we started investing in private debt strategies in order to mitigate the J curve and to the extent possible to not report a negative return, while at the same time trying to knock on some of the best VC managers out there to see if we can get access to their funds. I think the last 5-10 years have shown and have proved to our trustees and our committee that private capital definitely has a place in Helmsley's portfolio long term. Our target when we first launched the program was 25% of Helmsley's overall portfolio. We have since increased that target to 35, and through very good appreciation, we're currently sitting at 40. And so we are very strong believers. If you look at our performance in that segment the last 5 years, we've been up 25% annualized returns. And so that's probably more than 10% above what we've gotten from our public equity, our liquid market segment. And so I think for us, we invest with conviction. I think some segments within private capital, like venture, if you can't access very good managers, I don't think you should be invested at all, right? And for Helmsley, fortunately, some of the big VC managers have blessed us with allocations and have let us in. And so we're leveraging those relationships that we have to continue to build out our private capital program.
So I want to ask you a follow-up question on private debt with maybe another lead. So I'm not a big Twitter guy, but when it comes to SALT, you got to get your Twitter game together. And I posted something on Twitter last night that I saw that the European hedge fund index is now yielding 2.34%, where inflation is at 3%. So on a real basis, you don't have to be a math major to understand that that is upside down and negative. So when you think about private debt, or maybe you could take this as a general question too, Al, that if I think about the Sharpe ratio related to alts, it doesn't necessarily play all the time, but being compensated for a unit of risk being taken is something every investor should be thinking about. So either generally or more specifically in the private debt market, is it hard to find opportunity at this stage of the market where rates are so low, and particularly if you can't even get a positive real spread on high yield?
Yeah, so at Helmsley, how we structure our portfolio is that at the highest level, we have what we call safe assets, which are investment-grade bonds and assets that we could essentially liquidate within a couple days. And then we have our return generating segment, which has three separate components: the liquid segment, the semi-liquid segment, and the illiquid segment. And so we don't categorize those assets by asset classes, it's by liquidity, because we think as a grant-making organization, having enough liquidity to fund our grants year over year is our main objective. Within each of the categories, we have different return hurdles. Now, these aren't set in stone, but for anyone on our team to try to pitch something that gets into our illiquid segment, it really needs to deliver at least a 15% net return and something in the 1.5, 1.6x at least. Because essentially, because we're fully invested in our illiquid segment, those dollars, commitment dollars, are competing with some of the big VC managers. Mm-hmm. And those managers are returning well into the 20s, if not 30s. And so for our liquid segment, I would say mid-15s at least. Our semi-liquid segment, which is where we include hedge funds, I would say it's really hard to convince a team to buy something within that segment that's below 10%. And so it is hard to try to squeeze private debt into our portfolio. I have tried and gotten vetoed down, but with the current spreads on private debt, it's very challenging.
So Geeta, I was going to try to work through some verticals. I have a hedge fund question. If you want to follow up on private debt, you can too. But hedge funds have been, I think, to some degree unfairly become a bit of a punching bag over the last 12 years. And again, I think if you look at it as an asset class, maybe deserved. If you look at it as a complex industry with many different strategies tucked inside, maybe a bit unfair. But there's an interesting debate about hedge funds. Are they diversifiers or return enhancers? Do you have a view one way or the other on how do hedge funds work their way into your plan?
So we think of hedge funds as a little bit of both. I mean, I think from a diversification standpoint, there's the clear argument to be made relative to the long-only side of the portfolio, and potentially if there's a fixed income allocation as well. We try and be very deliberate about our hedge fund portfolio and think about those assets not only in their own absolute return type frame, but also in a bigger picture, holistic sense as it relates to the total portfolio. So we may have exposure to a number of different industries, securities, geographies, but separating the hedge funds out from the rest of the portfolio may make it look very different than the actual exposure. So we think of it definitely as a diversifier, but we also expect them to be able to add value over the long term. So each of those names in that portfolio are very specifically selected and evaluated to be able to add a certain part or to play a certain role, I should say, within the overall total endowment.
And at this stage of the market, tail risk hedging, does that work its way into the asset allocation mix?
So we've thought a lot about it, and we've met with a lot of providers in this space because we think there is a lot of potential opportunity there as it relates to payments that need to be made. As a health system, as you can imagine, over the last year and a half, we've learned quite a bit about what liquidity means, and particularly to a finance leadership of a health system. It's thought of very, on a daily basis, very closely. We think about it. So we have talked about tail risk hedging. We haven't implemented yet, but I think there are a lot of good players in that asset class that we may be talking to over the next year or so.
Angelique, from Penn State, hedging? Hedge funds,
yeah, we have about 11-12% in hedge strategies, but they're diversifiers for us. And we kind of established a long time ago that we're not going to do strategies that have too much beta in them. Like for these reasons, we don't do long-short equity typically with a 60%, 70% net long. It's something that we have never done. So they have pretty much collectively, they have a beta of pretty much 0 to anything. But we also benchmark them to Barclays Ag. So all they have to do is to do better than bonds. And so that's kind of how we position that. It's as kind of a bond substitute without the duration risk. And that makes a little bit more money.
Okay. Al, anything from Helmsley on?
Yeah, so our semi-liquid segment that I mentioned, which includes investments that Helmsley makes that invest in vehicles with up to 2 years of liquidity, where essentially we can put our money into a fund, And if we were to redeem, if we can get our money back within 2 years, that those types of vehicles, which includes hedge funds, fall in our semi-liquid segment. The framework I talked about before, we definitely see it as a return-generating asset, right? So if you look at the 5 hedge funds that we have in our current portfolio, the lowest returning one is a long-short credit special situations fund that since inception has done a 10% net return with like a 5% volatility. The other ones are pretty much equity-based strategies, whether it's healthcare or technology, really based on some of the themes that we have and some of the sectors that our team has where we think those sectors will benefit long term. And so the hedge funds that we have tend to be long biased, and they definitely are exposed to having drawdowns. In terms of hedging, we view, we have had experience investing in a macro manager that has gone net short, and we've ended up having a bad experience with that, and we ended up terminating that manager. But if you look at our overall asset allocation framework, we really toggle between safe assets and return-generating assets and manage that allocation, and we really view that as our hedge against downturns in the market. So if you look at our asset allocation today, we're currently sitting 24% in safe assets, so the Barclays Ag and Cash. I think while we are believers in the endowment model and in privates, the question you asked earlier, we are very different from other traditional endowments because we have such a big buffer of safe assets. And stuff like that, and we really view that as a hedge. And going into the pandemic, we also had about 25% in safe assets. And we think having that dry powder to invest and redeploy when the markets get shaky really helped us navigate the pandemic and the market downturn going into the pandemic.
Geeta, just to maybe complete the circuit here, maybe just real estate infrastructure. Real estate's been sort of topical because of the commercial real estate and return to work, whenever that might mean around commercial office buildings. And then infrastructure, obviously we've got a big bill that is in the works of being passed. Are either one of those areas that interest your plan?
Yes, we've been investing in both of those spaces over the past 2+ years. We have looked quite a bit more closely at real estate, particularly as many of the managers that we partner with are really kind of looking at those Class A spaces. So, New York City, Washington, D.C., all of the cities where you would expect there'd be quite a bit of disruption based on COVID. We've been very fortunate in that they have held up quite well, and in some cases have actually used this opportunity to partner and become very, very hands-on with their, with the managers on site, with the tenants. And so in that space, we've been, I would say, pleasantly surprised, or slightly overly, maybe a bit optimistic, more optimistic than we thought we'd be. We continue to make investments. We don't see the last year and a half as changing what our plan was before the pandemic. And so we continue to engage with those managers and those GPs and continue to talk about new fundraising, and are pleased that people are still in the market and still, getting plenty of LPs on board. So it's been better than we expected it would be.
Okay. Angelique, maybe I want to touch on maybe cryptos, and you've got a student population who's very activist to some degree around fossil fuels, but is your plan, you in cryptos or any kind of NFTs or any of these emerging platforms?
We've done some research, and we ended up allocating capital to a venture firm that is dedicated kind of crypto specialists. But that's more kind of, they don't do coins or anything like that. They invest in
so it's like the infrastructure.
Kind of the whole infrastructure, yeah. The digital infrastructure. In terms of crypto itself, we kind of disagree internally. We have a couple of people who are pushing and saying that this is something we need to be jumping into, and some people who are saying, no, not yet. And so we continue doing research, but anecdotally, I'm part of this email group which has about 60 other institutions. And so I emailed out asking about who's involved in crypto. I probably got 5 responses. 2 of them were involved, and the others said we're doing research. and the rest of the people said they're not doing anything. So I think there's a lot more talk going on the institutional investing side. Some bigger institutions have pulled the trigger and did some things, but sort of in my peer group, nobody's really doing much. More on the venture side, we have some other exposure on the venture, but not in actual. I'm not saying, I just don't know enough about it, so I'm on the side that says, let's just wait, hang on a minute. But that's kind of, we kind of haven't really pulled the trigger on the liquid side.
Okay, I'm going to come back to that at the end around some of these disruptive technologies. But Angelique, maybe just staying with you for a moment as a university endowment. Harvard, I think it was Harvard that is divesting from fossil fuels, and it seems like there's an activist movement in this direction. I want to pivot more toward ESG. Does Penn State have a view on ESG, or maybe more specifically climate? I think ESG has become a very confusing set of risks, and it's hard to manage ESG, but maybe you can focus on climate and how you think about that around natural resources, moving toward renewables and investments there.
So in terms of endowment, we didn't have the mandate, and we still don't. So the board resolution doesn't mention anything about it. Having said that, the university itself is obviously doing all kinds of things. There's sustainability office, and generally, university overall, since it's such a big school, probably can make more impact from that perspective. And you have to look at all kinds of different areas of research and things like that than the endowment itself. So we haven't really had too much of a push, but we're looking at it ourselves because I don't think it's a trend you can ignore. And we're also looking at how we can make money on the trend, right? So instead of kind of arguing with the student body, we actually asked a couple of students to intern this summer, and they did a lot of work in terms of sustainability and kind of surveyed other institutions as to what they're doing. And so we're trying to formulate some kind of a policy, but it just hasn't happened yet. But we found some investments. We made a commitment to a renewables kind of manager on the private equity side, and also working on the public side, interestingly enough, with our oil trader, who's starting a fund that's going to be focused on trading carbon allowances, metals, because even if you have windmills, you still need to build them off something, right? So, and also some equities that are focused on like batteries and hydrogen and stuff like that. So we're trying to kind of do well by doing good, if you will. So that's kind of where we are.
Yeah, I think this double bottom line is still very, very difficult. And I think that last point you made about the wind blows the hardest and the sun shines the brightest where people are not. And we need that midstream infrastructure if we're going to get it to the masses. So I think that some of these oil and gas companies have built great midstream capabilities. Maybe working our way back this way, Geeta, your views on maybe climate more specifically than ESG for the moment.
Yeah, we've thought about the topic quite a bit, as you kind of have to if you're in this space. And I think similar to Penn State, we have not come up with a formal policy yet. I think it will be driven by our team as opposed to from the top down. I think our board is quite happy to think that we're doing what we should be doing to let us kind of have at it. So we expect to bring a formal recommendation to our board in the next probably 6 months as it relates to how we want to intentionally invest. And that's kind of the phrase I've been using within my team. There are just so many aspects to it. Climate, obviously, extremely important, but ESG covers such a wide range of topics that in some sense it's almost overwhelming to try and think about how you'd even put things down within a policy. So particularly as we're not a faith-based medical center, we are an academic in some sense medical center, and so we are working very closely with the people at the university because they have had to confront this quite regularly due to student activity, and just trying to make sure that the types of investments we're making are aligned with the mission and vision and values of the organization, which we think we're doing, but I think we could be a little bit more deliberate about it going forward.
Is greenwashing a big problem?
I mean, I think it's something we're spending time on for sure, because I think it could very easily be something that creeps up on us and we don't realize it, and then we now have to have a sort of more formal evaluation of to the extent that it's been part of our portfolio or it could be part of our portfolio.
Al, your views, I don't know, within the endowment space it might be different, but you don't have a constituency maybe pushing this as an agenda item, but what are your views at Helmsley?
Yeah, so like Geeta said, Helmsley doesn't have a dedicated allocation to ESG or to energy or climate. Having said that, we have over the last 7-8 years committed and invested in some fossil fuel investments, and we've had very mixed results. And so what we found in terms of investing in energy is that you not only have to pick the right manager, but you also have to get the vintage year right, because the commodity cycle is so long and it could either really hurt you or really help you. And so for us, we said any commitment we make in the private capital segment, it really just needs to stand on its own. If we invest in energy or ESG or anything like that, we're going to be very opportunistic. Our team has been doing a lot of work in the climate space because we think this transition to a low carbon emission world is a theme that's going to last for decades. We've probably met with 20 or so managers in the space, but we focus more on the VC and growth equity type managers that focus on investing in the technology to solve some of these environmental and climate tech issues. But so far we haven't met anyone that's made it to the finish line, but we are doing a lot of work in that space.
Okay. Maybe a couple things, maybe off climate, but on the topic of ESG, transparency and the culture and relationship between the GP and LP, and maybe Angelique, I'll start with you. What's the current state of play in terms of transparency around GP and LP? And you hear about things about the use of credit lines to fund LP commitments and that have an impact on returns. Is transparency where it needs to be? Because now we're talking about democratization, a less sophisticated investor accessing these GPs, and we've got to be thinking about a client-first mentality. If we can't get it right in the institutional world, I fear that we're not going to get it right when we go more retail-based with democratization.
Well, I feel like we have decent enough transparency with our GP. This is one of the things that we require. And if we can't get the information that we need out of them, life is too short kind of situation. That said, I mean, obviously some of the venture firms are really sensitive to the right to know and all of that. And so we're not subject to that. But every time we talk to some venture managers, we have to write them a letter and explain and how it all works. And some of them are really difficult to get in if you have that kind of situation with the Right to Know Act.
Geeta, maybe a slightly different theme. Certainly, the CAIA Association, myself personally, have been very committed to DEI, which has been very topical, and that can manifest itself in many ways. And I've made a point that I will not get involved in panels that don't have some level of gender or race diversity. It doesn't very often play out this well with the three of you, but I do want to point out that this is an important undertaking, and actions matter more than words. But maybe talk about it from your vantage point, both as a woman, as a professional, and what your expectations are as you hire managers and their commitment to DEI.
Yeah, it's a topic that's very near and dear to my heart, and one that I spend a lot of time on, just thinking about, talking about with peers, with my colleagues, with leadership, and with managers. And it's kind of disappointing that it's 2021 and feels like we're still in the same space that we were when I started in the business. But we recently did an evaluation from a DEI perspective of our current portfolio, and it's really bad, very, very bad. And it's very disappointing because I feel like internally I felt like I've been having this conversation. I know I've been having it, but clearly I haven't been having it in the way that has affected any change. And so, we're all in very fortunate positions, and obviously Bill, you as well, in that we do have a fair amount of leverage as it relates to making an impact at some of these organizations. And so I think we have to be very deliberate about, similar to the way you phrased it, we're not going to do business with you if you're not addressing this issue in some way. And it's not about, doing the right thing. I mean, it is about doing the right thing, but it's about making money, right? It's about returns. I mean, diversity adds to returns. So to have everyone in the same room and look the same and speak the same and went to the same colleges, that's not really going to add value over the long term. So we're very committed to it. I have a lot of difficult conversations ahead of me. I can already feel that. But I think it's important. And, you know, to your point, I mean, there's no reason to have a panel with only, you know, all men anymore. There's just so many good female investment professionals and professionals of color that it's very easy to have a diverse group of people. You talked a little bit about Twitter. There's quite a lot of, you know, for people who are in financial Twitter, there's a lot of chatter about it. And it's very interesting, some of the people who I follow that have done some great work in this space, and they're fighting the good fight. And so I hope I can help in some way.
Well, maybe an observation, not an excuse. I think one of the challenges we face on many fronts is that this is a great industry. It's really not a profession. And I think the law profession, the accounting profession, the medical profession has done a very good job of moving this direction. My wife graduated med school over almost 35 years ago, and her class was 50% women 35 years ago. So it's harder for us to get that channel going, and there's a lot of great organizations. I think 100 Women in Finance is a sponsor here. We just got to figure out better partnership there as well. So we just have about 8 minutes left, and I want to maybe the final discussion about digital disruption, because it's been a big topic at this conference, and every session I'm in, somehow, some way it comes up. And it may not reflect itself in an asset allocation decision by any of you, but it's certainly on the forefront around algos or maybe hedge funds that are using algo-based decision-making models. But Al, maybe starting with you about how does this affect Helmsley? Are you thinking about it? Are you seeing managers that have more algo-based, data-driven investment processes?
Yeah, so in the hedge fund space, the hedge fund managers that we invest with are all based on just bottom-up fundamental research, so not necessarily quantitative based. Having said that, in several pockets within our portfolio, whether it's some of our long-only quant managers that are introducing some machine learning analytics factors into their models, or whether it's some of our VC managers building out data systems and to figure out what's going on in the startup world. And so we are starting to see some of that technology being used across our managers, but it's not like we're necessarily committing or allocated to a fund specifically focused on that. But having said that, in terms of broader disruption, whether it's technological disruption or whether it's disruption in the healthcare space, we really try to find managers that can, especially in the VC space, identify the trends and then invest behind those trends. And that's why within our private capital portfolio, we have such a big allocation to venture and growth equity. I think that it represents about 25% of our overall portfolio, so about 2/3 of our overall privates.
So Angelique, maybe a slightly different angle on this, and being from Boston, a couple observations. One is I worked for a trust company, a custodian, early on in my career, and I always thought that was a horrible business. Less than 1 basis point, you make it up in securities lending and short-term investment funds. Brown Brothers was acquired by State Street, 2 local Boston operations, at least headquartered there. And I look at that acquisition, I say, wow, this space has changed a lot, and data is the new oil, and the amount of data that these custodian banks have and the impact of that data could be enormous. So I don't know if you deal with your custodian or not, but are you expecting more and different things from your custodian and data from them and analytics that help you make any kind of decisions either around operational alpha or investment decisions?
We do. Recently, we actually changed custodians a few years ago for that very reason, because we've had the same one for so long that we were wondering what else is out there. And so obviously technology was a big aspect of it in terms of reporting and everything the custodian. I don't personally deal with custodian all that much, but I remember we were going through that process. We're kind of doing the same thing with consultants. We're right now looking around. We don't have too many, we right now have one, but we want to know what's out there. And obviously technology is like a big part of that RFP kind of process. I think you just have to, and the managers also, even fundamental analysts. You have to have data, you have to have technology. Computer can process things a lot faster. And I think those who don't pay attention to that stuff are going to miss out in the end.
Well, I saw recently that DTCC is talking about going to T+1. And I was thinking when I started in this industry it was T+5. And I just looked up just today to see how long it took us to get from T+3 to T+2. It took us 24 years. And to now be talking about T+1 measured in days, it's beyond silly. It should be measured in nanoseconds. It's crazy. So Geeta, from your standpoint, any disruptive technologies or opportunities around either managers or operational alpha?
So similar to Angelique, we also changed custodians a couple of years ago and are also thinking about our use of consultants. I think that old model of the traditional kind of field consultant is very different now, and a big part of that is due to the advances that we've been able to take advantage of in technology. There seem to be so many ways that we can use tech in our day-to-day investment process that I think we're just a little behind the curve relative to other allocators in this space. There's a lot that we should be doing that we're not doing yet. So I think that the providers who can harness that and can sell it as a real advantage relative to their competitors are going to be the ones that are the most interesting to us. From a manager perspective, we're very similar to Al. We're very bottom-up, fundamentally focused. So I get plenty of emails where I just say we don't really do quant. That being said, I think there are a lot of ways that fundamental managers can take these technological advances that we've seen and enhance their process, enhance the way they do business, whether it's trading or whether it's analysis, whether it's ex post sort of review, attribution. There's just a lot out there that are more pieces of that puzzle that we should be thinking about as we make investment decisions.
Thanks. So we're just down to a handful of minutes, so I think we're moving toward closing time. And I think it's always good to put a ribbon or a capstone around this, either a closing observation, something we missed. Al, I'll maybe give you the first crack.
So I guess a general comment. I think the last 5-10 years, from the allocator's perspective, it's been I guess fairly easy, right, to generate strong returns. If you had more risk, higher allocations to equities, higher allocations to venture and tech, then you did really well. I think given how quickly the markets have recovered following the pandemic, and given how extreme the valuations are today, the next several years are going to be much more difficult to generate returns on beta alone. And so I think for every allocator and organization, you really just have to figure out what skill sets and advantages do you have, Helmsley as well, like what advantages does Helmsley have compared to other allocating peer organizations, and really try to build and identify investments that leverage that edge and that skill set of the team members that we have on our team. And I think that's the only way we can invest with conviction with evaluations today.
Thanks, Al. Geeta?
Yeah, I would just take that idea a little bit further and say it's probably time for us to spend some good, solid block of our research and thinking about what is it we're missing. What are the gaps in our process? What are the gaps in our team? Where are the skills that we're lacking? And I could think off the top of my head at least 3 or 4 that we could really use some work, or we could really use some expertise in this area. And so I think making those hard decisions and thinking about where's the best use of our dollar? Every dollar that we spend on the investment team is one less dollar that goes to providing healthcare to our community. So we need to be very thoughtful and very deliberate about how we spend our money, and some of that is probably going to be thinking through what tools are out there that we should be using.
Thanks, Geeta. Angelique, final word?
Final word. Well, one thing I'll say that's unrelated. I'm reading this book. It's called Subtract. And everything I'm hearing, we always talk about adding things. And we're kind of predisposed to add things. And we're incentivized to do. And sometimes, like L, for example, they have a very concentrated portfolio. And sometimes it's forced to take a look and say, well, what can I subtract? Instead of just keep adding things.
Yeah,
I'll wrap it up on this.
I think it's an excellent point. Weed the garden, critically important. Please join me in thanking the panel.
Thank you.